In this video, I'm going to walk through calculating the contribution margin and variable expense ratio. We have a company that has sold 50,000 units in the last year. Total sales were 200,000. Variable expenses in total were 120,000, and total fixed expenses are 65,000. Our starting point is calculating the contribution margin ratio. Ultimately, the formula for the contribution margin ratio is contribution margin. If you recall from past chapters, that's sales minus variable expenses, contribution margin, divided by sales. In this scenario, that would be 200,000 in sales minus 120,000 in variable expenses would give us a contribution margin of 80,000 in our numerator. Divided by our sales of 200,000 is going to be 0.40, but we're going to convert that to a percentage by multiplying it times 100, and it would give us 40%. Again, it would be 0.40 or 40%. We can think of this another way and say if we had $1 of sales and our contribution margin ratio is 40%, 40 cents of that dollar in sales would be contribution margin. Again, that's another way of looking at it. Another thing that we're asked to do in this scenario is calculate the variable expense ratio. Our formula for the variable expense ratio is variable expenses, which in this scenario are 120,000, divided by sales, which again are 200,000. It'd be 0.60. Again, converting that to a percentage would be 60%. Now that's the long way to calculate it. Another way we can think about it is the contribution margin ratio and the variable expense ratio have to add up to be 100%. So if we already knew that the contribution margin ratio is 40%, we could have simply subtracted that from 100% and backed into the fact that our variable expense ratio must have been 60%. Again, they have to add up to 100%. This goes above and beyond what this question asks, but a concept that you need to know as you go throughout the chapter of how you can utilize the contribution margin ratio in calculations is you can use it to estimate what the impact would be in net operating income, our final number, on our income statement if sales increased by a certain dollar amount. For example, let's say sales increased by $1,000. We'd simply take whatever the dollar increase is in sales, in this scenario we're going to say it's 1,000, times our contribution margin ratio of 40%, and that would give us an approximation of what we believe is going to be our increase in net operating income. Here, that's 1,000 times 40% or $400 increase in net operating income. Now, if you recall when I talked about the contribution margin ratio, I also pointed out, you can think about it another way. If you have $1 in sales, 40 cents of it or 40% of it is going to go towards your contribution margin and ultimately your profitability. So that's why we can take that 40% or 40 cents of that $1,000 in sales to help us approximate what our increase is going to be in net operating income.